Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is February 11th, 2026, and we've got a returning guest coming on the show. Great to have her back. It's Nancy Tengler. Of course, she is with Laffer Tengler Investments. She's the CIO and CEO there. She's a frequent CNBC contributor. In fact, I missed her appearance today, but she was on today. An author, you do a little bit of everything, right, Nancy?
And shovel horse manure.
Okay, well there you go. I didn't have that on your bio, but I will add it for next time. So it's a real pleasure to have you on, Nancy, because last time we had you on, you have a different style than a lot of us here at IBD. You're more of the value, and right now that's kind of been the place to be. So talk a little bit about how you are running the victory lap right now with value widely outperforming growth, and what that's meant for your investment style.
Yeah, Justin, thanks so much for having me back again. I would call us growth at a reasonable price.
Yeah.
I'm trained as a classical value manager, but last year we were able to return just under 25% in our GARPy equity income value strategy. And then this year we're well ahead of the benchmark, the Russell 1000 value and the S&P. It is so great for value managers to be able to beat the S&P. We beat it last year, we beat it again this year. But what we do is we use relative dividend yield as our valuation metric. So management set the dividend as a portion of what they think long-term sustainable earnings power is. So we're really focused on dividend growth, because if they're raising and growing the dividend, they're optimistic about the future. And that leads us into some tech names that you would probably expect and some you wouldn't, and then
Hmm.
across sectors. And we began shifting the portfolio, not running away from tech by any stretch, but broadening out our exposure in industrials and consumer discretionary mid-year and third quarter and fourth quarter of last year.
Okay. Well, you mentioned consumer discretionary. How about the consumer staples? Because I mean that's been an area that has been really moving in a strong way. We had Matt Caruso on last week, and he was saying, "Gosh, when the staples do this well, I typically don't do so well." Uh, what kind of tuned you into those? Just to maybe start out.
Yeah, so we own one consumer staple, and that's Walmart. And it has
Okay.
been our poster child for old economy companies and Costco in a growth portfolio. But in our value, we own Walmart. Old economy companies pivoting to the new technologies. And now the little NASDAQ darling has really, others have realized the benefit of owning Walmart and the technological innovations they've made. Impossible, in my view, for Target to catch up. But the point, I guess, is that consumer staples have rallied in the first quarter, even into the second quarter, the last 2 years, and now this year. And
Hmm.
we think it's a trade. Because if you look at the valuations relative to the growth rates, we just think people are hiding out in consumer staples. And we got some earnings in the last couple of days. They weren't so good. And so the stocks have been selling off. I'm not going to chase that trade, because those companies are not delivering what we're looking for, which is earnings growth.
Hmm. Very good point. And you brought up the dividend. I mean, it almost sounds like the dividend aristocrats. Those dividend paying stocks that kind of raise their dividend. To a large degree. I know that there's ETFs that cover those. But it's interesting because a lot of the tech names. I mean, if there's so many analogs that people are pointing out to the 90s. And of course, one of the things about these tech companies in the 90s, none of them paid a dividend. But now things are different. Some of these tech companies, a dividend and actually raising that dividend is something that's become kind of a little bit more acceptable and almost demanded sometimes. Can you talk a little bit about that change?
Yeah, so the 90s, so I've drawn the analogy to the 90s for about 3 years now, and
Hmm.
mostly around the macro environment. And there are similarities for sure in terms of interest rates and inflation, but there are some dissimilarities that we can talk about later. But I think for us, the late 90s was not a lot of fun. I was managing money back then. Nobody wanted to talk to me at cocktail parties because we couldn't own any of the tech names. And now the poster child for high-flying valuation, Cisco is considered, and I think they reported after the close today, but it's considered one of the dividend darlings. They've been growing
Hmm.
it pretty regularly, not spectacularly, but we were able to get into Apple and Microsoft after they began paying dividends, and their dividend growth has been exceptional, as we've seen over the last number of years. In the old days, if when a company started paying a dividend, and I think this is why Steve Jobs did not want to, it was a death knell because it meant
Yeah.
they didn't have anything anywhere better to invest their cash flow. Now companies are getting penalized for investing their cash flow in capex and not getting penalized for dividends. So
Hmm.
we think it's somewhere in between. In reality, we think capex is good, but dividend growth tells you what management's thinking. And again, back to the Walmart example, they were raising the dividend 1 to 2% for years, and then once they started to see the future benefits of their technological investments, they began raising 8, 9, 10%, and that was a great confirmation for us that we were on the right track.
Hmm. No, it makes sense, but I guess I want to push back a little bit because one of the things, again, if you look at Microsoft, for instance, I mean, what good does a dividend of, a dividend yield of 0.9% do you when this is off 27% off its high? It's, you know, a
Oh,
net a net loss. So, you know, do you do you kind of have to look at the technicals as well? Because, certainly the dividend becomes almost meaningless if you're losing money in the capital
yeah.
appreciation side of things.
Yeah, so we don't buy the dividend really for the contribution to total return. We're buying it to get an insight into what management thinks about the future. That's
Hmm.
what relative yield tells us. But you're right. I mean, if there's a company that it is continuing to raise the dividend and the price performance is poor, then we go in and reassess whether the dividend is safe, whether they're committed to the dividend. Is management aware of the problem? I think Microsoft is aware of the software narrative that's going around. And then we either buy more, which we did last Thursday. We didn't know
Hmm.
Friday was going to be one of those best days in the market, but we did know that the stock had been punished pretty dramatically. But remember, too, it matters when you got in. And
Yeah.
so for us, the performance has been uh, nothing short of spectacular since we began purchasing the stock. And I can't remember the year they started paying the dividend, but it was right after that that we started
Hmm.
buying the stock.
Hmm. Well, you brought up software and some of the problems that software have had lately. Here's IGV, one of the ETFs that covers software, and I mean this has just been getting hammered. Of course, it didn't help the other day when Anthropic, came out with their Claude work that is basically, was destroying companies left and right,
Yeah.
in terms of, pretty brutal hits to their stock prices, because it's kind of a is it one of those things where the business model has to change? The software as a subscription was so revolutionary, Adobe and all of those companies doing it over a decade ago, and now it's like, well, if you can replace it with a new subscription to Claude, what do you need these old things for? So what's kind of your take on this moment that we're seeing in the last few weeks in
Yeah,
in
no, I
software?
that's the right question, Justin, and I'm glad you brought up Adobe because it was in our growth portfolio, and at one point it was in our 12 best ideas, but we saw a management that wasn't pivoting, and so we sold out of that name. And the same with Salesforce, which we may be ultimately wrong about Salesforce, but my objective as a portfolio manager is to be mostly right, and if you're
Hmm.
mostly right, you can generate excess total return over time. But I think those two companies are more, and in particular Adobe, are more at risk than a company like Microsoft,
Hmm.
that's vertically integrated, that has multiple levers to pull. But Adobe it's an example I've used. 5 year total return, trailing total return is a negative 30, around 30 something percent, 32 or 33. And that's in a bull market. And so I think, I was getting a lot of questions around the Tesla pay package, when, what did I think of it? And I actually think the Adobe CEO pay package is more egregious because over that last 5 years, he's been paid $220 million. So we didn't want to be in that name anymore because we thought it was at risk. If from an image standpoint, I told you before we started, I wrote an AI country western song.
Yes.
It took 5 minutes. Grok wrote the lyrics and Suno wrote the music, and
Uh,
it's really good.
uh-huh.
So this
I forgot to put that in your bio as well, Nancy. I
is a songwriter.
apologize. Next time, along with the manure shoveling. Well, one of the things that when we were chatting initially, I really love your phrasing. That all you have to do really at the end of the day is be mostly right, and I want you to kind of go into that a little bit more because a lot of folks, when they're either sharing their knowledge at cocktail parties, they always want to talk about their big winners. They never want to talk about the things that they were wrong on.
Right.
Yet, sometimes there is something about how you handle the ones that you're wrong on, and how you handle the ones that you're right on, how you get more money into those. What's kind of your philosophy, and how does mostly right save the day for you?
That's the right question again. So, uh, some of the best work we do for our clients are the names that we got out of or the ones we never got into in the first
Yeah.
place.
Hmm.
And that's hard to quantify. So but it shows up in total return. So I'll give you an example. I can give you two examples. I wrote a book on investing for women. And when I was working on it in the first edition in 2014, I was trying to find a way to explain how you put a portfolio together. So I'm Googling late at night and I came across an interview I'd given 10 years before, didn't remember it. And so I said, well, this is perfect. I'll just look at the performance of the five stocks. Two dramatically outperformed the market, two kind of in line
Hmm.
to underperforming, and one dramatically underperformed. Yet that portfolio was up 100 full percentage points cumulatively from 2004, April 2004 to 2014. Fast forward, last year I had a 5 for 25 portfolio. One of the names was ServiceNow. That was down 27% last year. Spotify was in there. Goldman carried the day. I can't remember right now what the other ones were, but that portfolio was up 28% last year, even with ServiceNow down 27%. So
Hmm.
that's what I mean when I say mostly right. Now, in real life, as soon as a stock gets clobbered, we go back in and do the fundamental research. We have a proprietary model, the 12 fundamental factors, 3 qualitative, 9 quantitative. We go back in and say, would we buy this stock again today? If the
Hmm.
answer is yes, then we add to it. And if the answer is no, we exit. That's what we did with Adobe, Salesforce, Zillow many years ago, CVS. Those are names that Intel, poster
Hmm.
child of underperformance. So those are names that we got out of because we didn't think the management was on top of it. We didn't think there was a catalyst for outperformance. And so in every case, we got out at much higher levels than the stock is trading at today.
Yeah, and I would refer to your last appearance on Investing with IBD because you did go through that 12 metric framework. You shared your 9 quantitative and 3 qualitative uh, metrics, and talked a lot about the the strategy of buy and hold but verify or something like that, if I remember correctly. To make sure that it's worth holding. And to your point, it's one of those things. Would you buy it today?
Yeah.
So I also want to kind of share some of the things. You brought some slides to share with the class, so I want to make sure we get to some of those because I thought that there were some really interesting points that you were making here. So I'm going to go ahead and switch over to some of those slides. And one of the first ones that I found really fascinating, again, because a lot of people are so focused on the the macro, the geopolitical, the noise, all of this, this wall of worry that we've been climbing, it seems like, for so long, with headlines tossing us to and fro. And you have this, pretty neat chart about how the geopolitical crises will sometimes create opportunities. So maybe explain what your thesis is here.
Yep. So this is from Ed Yardeni, the master chart maker. And
Hmm.
I can actually just share a real life example. So I was managing money beginning in the 1980s. And 1990, Iraq invaded Kuwait. We had just taken on a $100 million client. I was investing from the labor and delivery room, which don't do the visual, and the doctor pulled the phone away. But the point was, I was frantic because the market was melting down, and we were trying to get the money invested, but not too quick. You can imagine.
Yeah.
And so at the end of the first 2 months, the 100 million was now worth 80. And then we went on to be their top performing manager because what happened? Well, we went into Kuwait, the US that is, and the day we entered, the market went up straight up. It really bothered people.
Yeah.
They were like, it should go down. What's this is war?
Hmm.
But it went up because the uncertainty was gone and it kept going up thereafter. And so we've seen that. We saw it with Russia-Ukraine war. Most recently with the Hamas Israeli attacks, you can see we've just continued to climb that. And then if you go back, and I'm looking at the chart, so I'm not losing my mind, but that's what happened in every single situation. North Korea, the market went up. Cuban Missile Crisis, the market went up. It naturally climbs a wall of worry. But what the reason people don't think that is because the bears always sound smarter than the bulls. The bulls are like the eternal optimists, which I'm,
Right.
I'm not necessarily, but I'm more optimistic than I am pessimistic because I believe in our country's ability to adapt and innovate, and that's how you generate earnings growth, and that's what drives stock prices.
Hmm. I'm just gonna. I know this isn't your chart, but maybe next time I run into Ed Yardini, I'm gonna say, hey, maybe add 2003 because I thought that was an interesting one too.
Yeah,
March, I want to say March 12th or March 17th, we had what we call a follow-through day, and that was right around the time of shock and awe
yeah,
that was happening, and it
that's a great.
finally kind of pulled us out of that ugly dot-com bubble bursting and the bear market that ensued, where the Nasdaq was down 79%.
And
Um,
3 years of moribund returns. Yeah,
yes,
yeah,
absolutely.
that's a great
So
point.
yeah, no, it's a great chart, and to that point, one of the things that does happen, and you and I are going to spar a little bit on this one, because you make a good point that uh, a lot of times you espouse the belief that um, your time in the market is a lot more important than timing the market. And I think this is the poster child for that point. So maybe describe what this is showing our listeners here.
Yep. So it's a 30-year period, and it was developed by our friends at, anyone can do it, but our friends at Strategas published this particular chart. And what it shows is if you were invested in the S&P 500, you would have returned 9.1% annualized over that 30-year period. If you missed the 5 best days, your return declined to 7.4% annualized. If you put that in dollars, 9.1% over that 30-year comes in above 13 million. I think it's 13 and a half. And then if you missed those 5 best days, you were able to still generate 8 million, but the difference was over $5 million.
Hmm.
And I think if people think about it in dollar terms, because if you look at it, you go, well, 9.1, 7.4, it's not that big of a difference. But the compounding of that over time becomes compelling if you're interested in generating wealth for your future. And that difference is big.
Yeah.
13.5 million versus 8. That's a lot of dough.
And you know what? I'm gonna skip ahead because this
Yeah.
really kind of illustrates that point. And for people that haven't like done these numbers themselves, it's again, there's so many things about the eighth wonder of the world being compounding, the magic really, and it does feel like magic sometimes because the early years are such a grind. You just don't see that much of a difference, but then later on, if you are able to pull that lever a little bit of raising your performance just slightly, the difference it makes, after 10 years, 15 years, it becomes really astounding. So, to your point, if you can do anything that just increases that average a little bit, that average compounding annual growth rate, the results are astounding.
Yeah, no, that's true enough. And I go through example after example in my book because I've made every mistake you can make. And I usually made it in my kids' portfolios, so it didn't hurt as much.
Yeah, there's a lot of runway, right? You can make the mistakes when you're young.
Right. But Starbucks is a classic example. As we went into the bear market, it had already sold off. It was down about 30%. Being a value manager, I didn't get to own the cool stocks, right? We already talked about that. So I bought it for them, and then it went from 30 during the bear market, the great bear market in 2008, 2009, down to 5.
My
And
goodness.
I wasn't looking,
Hmm.
that was the good news. I didn't sell it. I should have bought more. I didn't buy more, but I was still up a compounded return of something like 14 or 18%. I can't remember. It's in the book, but it was ridiculously impressive. So great companies, great management teams, S&P, whatever your choice is. My view is you should stay invested.
Hmm. Okay, so this is where we're gonna fight a little bit. So put on your boxing gloves.
All right.
So as I've looked at these, top 5 days or top 10 days, one of the things I've noticed is that they are surrounded by the worst days. So I always thought it was a little unfair to kind of say, oh, let's take out the top 10 days and not the top not the worst 10, because if you look at the top 10 days, you're going to notice some very distinct time periods. For instance, you're going to find those top 10 days in 2001, 2002, 2008, 2020, the COVID bear market. And most recently, one of those best days
Yeah.
was in April of 2025. So it was surrounded by some of the worst days in the market history. So are you being fair here?
Well,
So what about those worst days that they're always surrounded by?
I think so, Justin. I mean, the worst days they show up in the fully invested for the entire time period.
Yeah. Hmm.
So they're there. The difficulty is that the worst days usually force people out,
Yeah.
and for obvious reasons that you raise, which is it's
Or
painful.
scare the heck out of them, right?
Exactly. And so,
We can't all be blessed enough to not look at Starbucks when it goes down to 5.
well, that was in the old days where you got statements, physical statements from your accounts, and I would just chuck them into a drawer and not open them.
Uh-huh.
And that's what I tell my clients to do, because if you do get scared out of the market, and it was the great Peter Lynch that said, "Don't let the market scare you out of stocks," and I think that's right, because yes, you will endure the worst days, but they're embedded into that 9.1% fully invested over 30-year
Hmm.
period. And so the power of staying in becomes more powerful than the power of getting out, because what happens is the reasons that you got out are the very same reasons that keep you from getting back in.
Yeah.
And that we've seen that with famous strategists. Remember Elaine Garzarelli? She got 1987,
Mm.
100% right. She did a bunch of legs commercials for nylon hose, and then we never heard from her again.
Hmm.
She never got back in.
Yeah. Yeah. No, it's a very, very good point. And this is where, again, let's go back to Starbucks. I'm going to go ahead and just show a long-term chart here, because I think this is another point. Our I've always been a big believer that for your broad-based, whether it's an index like the S&P 500 or broad-based mutual funds or what have you, you can kind of get away with that to a large degree. But my concern is always with the I guess the single stocks, right? Because there are certainly these cases where yes, your single stocks and I'm going to pull up Starbucks. So in the case of Starbucks, as you mentioned, it did come back from that real devastating time period in the 2008 Great Financial Crisis. But what if you were what if you were holding on to something like a Bear Stearns or a Lehman Brothers? So there are those cases where they don't, and so if you bury your head in the sand and kind of throw your statement away, what happens when one of those just takes you out? How do you protect yourself?
No, that's the right point. Well, you diversify, as you've heard. We run
Hmm.
concentrated portfolios at Laffer Tengler, but and I mentioned the 5 best, right? Where there was one stock that was down
Yeah.
27% last year, which
Now
seems,
service now, right?
and is down again that much again this year. But I think we do research, so we're always revisiting, verifying.
Hmm.
But as an individual investor, I think you either have to have an iron gut, or you have to buy more diversify the number of names across sectors. So
Hmm.
there's this whole sort of ecosystem around Tesla where you've got, and meme stocks, you've got a lot of those investors that just own those meme stocks or that one stock as in Tesla. And that may not be a bad strategy. I mean, the greatest wealth in the world has come from one stock. Think Bill Gates, Elon Musk,
Hmm.
a number of entrepreneurs, Larry Ellison, David Duffield. And so I do think there's something to be said for buying industry leaders with savvy management teams. But as a retail investor, I would encourage your viewers to use your charts because they give you, and I didn't answer your question earlier, technicals matter
Hmm.
because they tell you where the momentum is and what's behind the movements. And so I think you have to be willing to look at the technicals. William B. O'Neill was one of the all-time great investors for this industry, or researchers, however you want to characterize it. And you are the beneficiaries of that because those charts are probably the best in the business.
Yeah, and definitely, it's not all technical because a lot of times that's what a lot of folks, will focus on, either technical or fundamental, and certainly
Oh,
Bill O'Neill's, combination of the two
right,
back in the '60s was a little revolutionary in that
right.
regard. So yeah, no, thank you for that. That was a nice plug. I appreciate it. Um, so. Um, so I guess with some of these stocks, and again, it's very easy for a lot of people to sometimes hang their hat on well, all you need is a Microsoft or a Tesla, and it wipes away a lot of sins of the underperformers. So how do you know you have one of those? Because sometimes you can have all the things line up and you're like, well, this has got to be, the greatest thing since sliced bread. And then it just never takes off. Yet sometimes there are the things where there might be all of these. I mean, how many pot shots against Tesla have there been? Like, oh, well, that doesn't deserve to be the number one car manufacturing company when they, especially very early on when they were manufacturing the least amount of cars of the big automakers. So I guess, how does your research kind of guide you to find those that you do need to stick with and kind of get out of the ones when how do you know when you're wrong, I guess?
Yeah, that's the hardest part. I think it's the art form of this business. But
Yeah.
if you think back to like a name like Xerox, so they were one of the Nifty 50
Yeah.
and growth stocks, and they were ahead of everybody. And then they developed the mouse, and they forgot to do anything with it. And so who monetized it? It was Apple and Microsoft monetized the mouse, and Xerox went on to oblivion. Same thing happened to Polaroid. Same thing happened to Intel, where you had management teams that, I mean, in Polaroid's case, it was just, it was a change in technology. It was
Hmm.
cell phone pictures or digital pictures.
Yeah.
But in the case of Intel, you had a real lapse at the board level. So the wrong CEO in for a long time, then the new CEO, and he just wasn't up to the job. And you could kind of see that because nothing was happening, same as at Adobe. So I think you don't have to pay as close of attention as I do, but you should read the earnings recaps and you should see if managements are pivoting to the new technologies. And that's what Doug McMillan did at Walmart, and that's what Brian, I've already forgotten his name, did not do at Target. Uh,
Hmm.
Quick anecdote, there's a company that we own in our thematic portfolio called Symbotic, and they are an automation robotics company. Their first client was Target, but Target did not implement the software. You know who did? Walmart. And now
Mm.
30% of Walmart's deliveries are made in less than 3 hours. 50% are fully automated and never
Mm.
touched by human hands. That's how you pivot. And you had a really savvy CEO, and you could see it when he bought Jet.com and got into e-commerce. He knew he had to beat or catch up with Amazon, and they have.
Yeah, no, it really has been amazing. Again, I only know that because of the boxes that are, piled up on my doorstep.
Less
My
than
wife,
3 hours.
definitely uses an Amazon a lot, but one of the credit cards that we had gave us like a Walmart. Yeah, I can't remember what it is, but it gave us that monthly fee, a credit for it. And she started using that. And yeah, sure enough, I mean, she would order something and, the same day, it would just be there, later the same day. I mean, it was just,
Nuts.
again, astounding. And then I haven't experienced this myself, but I guess at a lot of Sam's Clubs, you can actually, pick your stuff up, kind of scan it as you're shopping, and then you just walk out the door. You just bypass the cashier completely. And again, as you said, some of that technology being aware. Target certainly had that benefit during COVID, where look, the curbside, delivery was a game changer. But
Yeah.
I think Cornell was the name you were looking for, Brian
Brian Cornell.
Cornell. And yeah, it's Target hasn't really done much since. Nancy, there were a couple more slides that I wanted to share because again, I think to your point of some of the differences here. Definitely come down to the balance sheet and, as you said, some of the things that you pay attention to. But before we get to the balance sheet and some of those differences, I wanted to bring up this one because the Deep Seek, which was January 27th to Liberation Day, which was April 2nd. This was last year, 2025. And then Liberation Day to year end. So again, one of these situations where there was a lot of angst about, what was going to happen and, what ended up happening from, I mean, April 2nd was kind of close to the low to the year end. Was just absolutely phenomenal. So maybe talk a little bit about what this what this data means to you.
Yeah. So I happened to be on CNBC the day of DeepSeek. It wouldn't have been my first choice.
Right. Yeah. Not the day you would have picked.
And they weren't just hitting technology, they were hitting all the infrastructure names, anything remotely associated with AI. Because remember, the Chinese allegedly built this $6 million
Yeah.
inferencing model that turned out they had about, I don't know, it was 10,000 NVIDIA chips, some ridiculous number. But the point was everything got clobbered. And then, it didn't get better fast. And so we actually, we let things settle, but we went in and bought a number, not all these names, but a number of them in the period. And then, I just wanted to show the difference that once the tariff tantrum was over, many of these names took off dramatically. So, you look at AMD, it was down 10.5% from Lib Day to at year end, it was up 108, and it had a 77% total return if you were in it for the whole year. And so we were buying names like Palantir at $88 a share, NVIDIA at 108, Tesla at 240. And that's how you make money. It's never easy because you're going against conventional wisdom. But we thought that, Jevon's principle would prevail and that
Yeah.
the more the merrier in the technology, in the AI inferencing and agentic space, the better. And so we added to a number of these names, although, as I said, not every single one. And the only loser is ServiceNow.
Hmm.
And the question we keep asking ourselves, because Bill McDermott is a great CEO, but the question is, are they going to be able to pivot? I think they
Hmm.
are, but you may not ever recoup previous highs. And so
Hmm.
we're wrestling with that one. But Symbotic is a classic example. I just mentioned it was down 20.6%, but it was up 170. And
Yeah.
that's what you have to pay attention to during these periods of stress. If you believe this is a transformative technology, and AI isn't the only technology, think robotics, space, quantum, nuclear, those technologies are going to change the way we live. And so we're viewing this as a transformative set of technologies transforming the economy. And we've had those periods in the past. They last for decades. Industrial revolution, the energy, boom and boom years, when the internet, they last for a long time. And so we want to be part of that.
Yeah, no, absolutely. And for those that don't know about Jevons paradox, that wasn't something I was aware of until, was it the Microsoft CEO mentioned it like a couple days after,
Oh, he
DeepSeek and
did. Well, I
yeah, and
mentioned it the same day.
did you? Okay, well, you know what? I'm gonna from now on, I'm gonna say Nancy Tengler. Was there first. I did hear it from the Microsoft CEO, and
Yeah.
yeah, it's again a very interesting concept that, which, as you said, was from the Industrial Revolution with steam engines. That hey, uh, you know, efficiency gains, don't curb. Uh, Growth and resources, it accelerates the use of those. So yeah, that was definitely. Now, how does that kind of play out with this latest with Anthropic? Because again, with Anthropic, I think a lot of fear is that, especially with software, kind of to circle back where we started almost, that some of this is, you know, kind of game changing for these moats that some of these companies had.
Yeah, that's the hard question. And I think a couple things. So first of all, just remember that a year and a half ago, Google was in the Russell 1000 Value Index.
Yeah.
Nobody wanted to touch it. They came out with Bard, and it was a disaster. And so they went back to the drawing board and very quickly rebranded as Gemini and are now considered the leader. And the
Hmm.
stock's up 150% since, I mean, we owned it in growth, but we put it in our value portfolio in August of 2024, and in our ETF TGLR, which is the same as our value portfolio. And so that's how quickly these situations can turn. And I think this sell-off is driven by the algorithms, exacerbated by the hedge funds. And now we have to let the sort of rubble settle and see who we think is going to survive.
Yeah.
And I think Anthropic, well, for example, the country song that I wrote with AI, is that going to displace Spotify? I don't think so. They came out
Mhm.
with earnings. They were pretty decent, and the stock was up 15% the other day. Spotify will get into AI music if they think it's a threat to their business. And so when you own the industry leaders, they have the best odds of making the pivot during during transformative changes in
Right.
technology. But we're still, the graveyard's littered with the Xeroxes and the
The ones that didn't, right?
yeah, so you're not gonna always be right about these, but the goal again is to be mostly right. I don't think Anthropic's gonna displace everything.
Yeah,
I'm probably not gonna
absolutely.
write another country song.
Very good. So one more thing before we get to your six for 2026. So folks, hold on for that. Um, I wanted to go over this tech balance sheet that you created. Again, because I thought this was very interesting. Certainly, that comparison to 1990s when the internet, was really going through its build out. Of course, Cisco being one of the big players there, as networking and fiber optics with your broadband and everything that kind of came along with that. But there was also this element of, oh, just slap .com on your name and that's kind of a business model that's okay in this new economy. But this time's a little different in terms of these balance sheets. So maybe you could describe that.
Yeah, so the circular financing that everybody loves to talk about right now was in place in the 90s. And again, there are a lot of similarities that I think were important to note a few years back, and we did, and it benefited our portfolios. But this was not one of them, because the circular financing in that period was financed by debt. And so what happened to Cisco was, a number of their customers went bankrupt,
Hmm.
and that's when the stock plummeted. It was trading at 100 times estimated earning, or I'm sorry, past earnings, peak earnings, let's call it.
Hmm.
And that's probably not sustainable. We don't have those kinds of valuations. And what we do have is just look at Google. Its balance sheet has about $126 billion in cash. Microsoft is 89. That's more than most countries. And then you go down the list, Nvidia, Amazon, tens of billions of dollars. And then even Oracle has cash on the balance sheet. And Oracle's always been a big user of debt. We've talked about that a lot. Last August, their debt to equity ratio was 500%. It's actually gone down since they've announced and gone to the debt market. It's up something like 400 times, or 400%. But I just point that out because if you're funding CapEx out of free cash flow and earnings, cash on the balance sheet, that's actually what companies are supposed to do.
Hmm.
That shows that they believe they're going to monetize this, that they have growth opportunities. If it were just one or two, if it was just Oracle, I'd be concerned. And it's not to say, Justin, I'm not concerned about OpenAI. I don't think Sam Altman, um, think he's a little bit of a bad actor. I'm hoping that a year from now we're talking about a new CEO at OpenAI,
Mhm.
because they're throwing mud at the walls and hoping that something sticks. And the advertising, the e-commerce, the erotica. I don't think that was the intention of OpenAI when it was created by
Right.
Musk and Altman. So I'm concerned about them as a player and all the money they're raising and the management of the company. But you also have Microsoft in that mix, and it could easily be something that gets folded in somewhere else. So we still are optimistic about the AI trade, but we are wary of companies that are concentrating all their activities with
Mhm.
OpenAI.
Mhm. And there's certainly something to be said for, the competition side of things. I mean,
Yeah,
Google, of course, I think did have to up their game, because again, the fear was that search was going to go by the wayside,
yeah.
and replaced by AI, and then, they figured it out, and as we looked at that chart,
Good
they figured it out.
management. They
Yes.
pivoted. Yeah.
Yeah, absolutely. Okay, Nancy, let's talk about your six for 2026. So, folks, get your pencils ready. And look, this is a very hard thing to put on. I want to say any portfolio manager because things change, headlines change. But you've kind of got a list of stocks that you're looking at, and as you said, they don't all work. But if you can be mostly right, uh, then that's usually good enough. So, what do you got for us?
Okay, so my first name on this list was Walmart, and it's had a heck of. I'm sorry, I'm looking at the list because, of course, I can't remember it, even though I put it together. So it's Walmart, and for the reasons I've already described, their
Mhm.
digital business is growing, their delivery times are improving, they're using robotics in the store, so they're able to upgrade the quality of people's jobs, and all of that inures to the bottom line. And so same store sales or same store comps have been pretty remarkable for a company that large, and the e-commerce business is growing like crazy. Now that you add in advertising, there's a lot to like about the stock. Valuation is pretty rich now, but that can happen. That can stay rich for a long time, and I think they will continue to deliver.
Mhm.
Advanced micro devices. Last year on our 5 for 25, it was Broadcom. This year we went with advanced micro devices, and the reason for that is the CEO Lisa Su. When she took over the company, they had 0% market share in CPUs, and that was 2014. Recently, they were at 41%. So again, in the old days, we used to laugh that the only reason AMD was in business was to keep Intel out of the antitrust uh, bullseye. And my, how things have changed. So they are expected to grow, in data center. I think at 80%. That's powerful. And also, the valuation is not out of line. They're trading at a PEG ratio of 0.5 times. So earnings growth is in the 30 to 50% range, depending on which period you look at. She's expecting to grow EPS at 64% in 2020 in fiscal year 2026, and the multiple is obviously well below that, about 30 times, 28 times. So a PEG ratio for a growth stock with that kind of growth of 0.5 times is a name that we want to own. The other one is Tesla. I'm just not going to bet against Elon. I did it once, and it cost me a lot of money. This is a guy who describes himself as programmed for war. He's in war, and the recent combination of SpaceX and XAI to us is emblematic of what we think will happen with Tesla and those two companies now. But importantly, full self-driving and robotics is why you want to own this name first and foremost. And then battery storage is the other. It's not for the EVs. They are to Tesla what iPhones are to Apple. It's
Mhm.
about the services business, the ecosystem with Apple, and the same is true with Tesla in our view.
Mhm.
CrowdStrike, cybersecurity, gotta own it. This is a company that we think is one of the best and is benefiting the most from agentic AI and at the company level and at the platform level. Power Quanta Services is an infrastructure name that has had quite a run, but we think can run further. The backlog is ridiculous at this company, and the data center commitments and growth is something we think will get delivered on, and they're in the pole position in that space. And then we just think housing, we came up with these in December. We thought housing would begin to recover this year. DR Horton is our choice for that because they're the lowest cost homes and the lowest cost provider, as well as in the sweet spot geographically. So think Southwest and Southeast, and not
Mhm.
Northeast or much in California. So we like the name, 378,000 average cost for a home. We think that's going to benefit the first time buyers. And that's, I think, what the administration's going to incent.
Mhm.
So we like the name.
Yeah. Well, okay. So just since we have the numbers up on this one, I know that fundamentals and the balance sheet are important to you. What about something like this, where the the numbers recently have been kind of on this, these negative. It's still making money, right? Certainly, but you've got an EPS of 2.6 versus a year ago to 2. So that amount of profits have gone down. Is this? How do you know that this is kind of a cyclical, action, or indicative of some trouble in terms of the growth side?
Yeah, no, that's again the right question. This may be the name that doesn't work,
Hmm.
but if it works, it's going to work spectacularly. We know it's cyclical because we know what's going on in housing. We're in a housing recession. This is on the heels of higher interest rates and previously higher inflation. I was talking to the team in Scottsdale, and most of them rent, and their rents haven't gone up. One, one,
Hmm.
one gentleman's has not gone up for 3 years. So we think that housing is about to turn over. Prices have come in some, and DR Horton, they've been sacrificing earnings by buying down mortgages to keep the houses moving. And that's
Right.
what you have to do in an environment where cyclically you're not in favor. So we think housing is going to recover. We could be wrong about that. The administration has had a hard time getting their ideas through Congress.
Hmm.
I think if they don't, they're likely to lose the midterms, and I don't think that sits well with the president or the Speaker of the House.
Hmm.
So I
Yeah.
expect to see them continue to, extend the duration of mortgages, you know, all the gimmicks that they've come up with, but they will work.
Yeah.
So
And again, all you need is one thing to kind of turn things around. So you keep on throwing things at it, maybe something sticks. Well, Nancy, it was a pleasure having you on again. It's really nice chatting with you. Again, we have different styles, but I absolutely see value, if you will, in what you do. And again, I'm also very intrigued when our stuff overlaps, something
yes,
like a Quanta Services, PWR. It's like, yeah, it's amazing how much we're looking at the same names
yeah,
sometimes
yeah.
because again the growth and value overlapping. So again, pleasure having you on, and next time maybe we'll put you out with your country song that you created on Grok. Oh,
Thank
one more
you.
thing I should have mentioned. Again, you mentioned it earlier, but I want to make sure that people know about the ETF that you run. You're the portfolio manager for,
Yeah.
TGLR. So this kind of gets folks access to that value side of things. And again, you can see some decent relative strength versus the S&P 500 here lately. But yeah, TGLR is the ETF. So.
Thank you. Thanks, Justin, very much.
Thanks again for being on, Nancy. I appreciate it. That's going to wrap it up for us this week. Thank you so much for watching. And next week, we're going to have Scott St. Clair coming back on the show. He, of course, is our senior manager of premium products. And of course, we've been talking a little bit about how Market Surge is going through a reboot. We are going to have a lot of different things coming out, a whole different infrastructure behind our program. And Scott St. Clair is going to walk you through it. We already have the beta version out right now for people to kick the tires on that and see what's coming. And he'll walk you through some of the features that are coming. So hope you join us for that. We're going to be live at 5 next Wednesday. See you then. Take care, everybody.